Good morning, everyone. Thanks for joining us for Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Dimitri, myself, Market Chameleon are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, Dee, good morning.
Good morning, Will. How are you?
Good.
Good morning, everyone. Let me share my screen here. Uh, 1 second. And um, today, what we'll do is cover a tool that tracks the performance of a stock um, after it reports earnings. Has let's say we give it a investors and traders a day to consume an earnings release and announcement. And during an earnings announcement, we're going to look at Meta happens once a quarter, so 4 times a year. The management releases their financials, comments, notes, conference calls. A lot of them have conference calls with investors and analysts, and that during that period, there is a lot of information that's released to the public, and the public, the traders, the investors interested in that stock, while that stock can take that information, put it into their models, and reprice the stock. And the idea there is that once that information is out there, we see typically, a lot of volatility where, that's now reflected in the new fair value of the stock. People's models can adjust very quickly and trade it to get a new market fair value. Well, the stock doesn't stop trading after that day. It continues to trade up to the next earnings, right? So now you have this period where we don't know on a day-to-day basis, the daily revenue and sales and issues, like whatever is happening. We don't really get a live feed. We get a lot of information once a quarter, but during that period, the stock continues to trade, and it can move away from that initial repricing, up, down, could have a lot of volatility. So what this tool aims to do is look at what does the stock tend to do after it gets repriced. It could be positive, it could be a negative reaction to earnings. It gets repriced. Then what does it do? Because there are other things that can move the stock. Is you could have news in between. You could have economic events in between, but you also have this kind of flow of money into the market as well, right? So then you get this natural kind of flow into the market from pension funds, mutual funds, people's check, their weekly or bi-weekly checks gets deducted and gets put into the market. So you get this natural flow. And what we want to see is, like, how does this stock typically drift in between there? What type of volatility, from what are the historical movements from the closing price to the high or the low of the in between that period of earnings announcements. Okay, so we're going to use Meta in our example here. So if you type in Meta up top, the symbol, you will come to the summary page, and on the left-hand side, the menu, we're going to click on earnings, and here we're going to do a post-earnings drift. And then we come to this page. I'm going to close this menu to expand our screen. And we have a graphical view up top, and then we have this table view below. On the graphical view, this shows us the history of the stock movement in between earnings announcements. So this doesn't include the earnings announcement itself. So that performance, whatever it was up or down, is excluded. It looks at it as, well, if we measured from the day at the end of day after reporting earnings, right? So if it had reported earnings, it could get repriced that day. We look at the end of day's price and we measure it up to the end of day's price before the next earnings. So that's what this is looking at, that drift that doesn't include any the repricing of the earnings. So there are two things here. The green or red bar represents green for positive earnings drift, red for a negative earnings drifts. So here we could see, between these earnings, Meta was down. Let me see, 26%. The next one, it was down 17%. Here it was down. Now we got up over here. The earnings effect this blue bar, that shows you what it did the day of the earnings. Okay, so we see that it was, the drift up to the earnings was negative. When it announced earnings, then the stock price was positive 17%. Okay, so it gives you both of those measurements to compare to each other. So let's come down to the table, and here just kind of lets you see if you spot any type of patterns or trends or of what's going on. So here we have a positive drift followed by positive earnings effect, positive drift followed by positive earnings effect. So this will kind of just show you that history. And then this table below, these are summary stats, and these are the individual earnings. And there are a couple things here. Up here are the averages. Then you have absolute averages, and then you have like median, minimum, max. On this first column here, the average, that gives you the average price impact on the day of earnings. Okay, so this is on average. If we took the actual earnings day, like what did it do from the previous day's close to the next day's close, once earnings were reported. On average, the stock was up 3.2% with 58% of the historical observations in the last 12 quarters. Here you could switch this. We're positive, 42% were negative. This shows us the earnings, actual surprise earnings per share. So on average, the earnings per share were better by 33 cents. So if we take the difference between the average expected earnings versus the actual, it was better by 33% on average, was 75%, beating 25%, missing the expected earnings per share. With the revenue on average, it beat by 800 million, with 83% surprising to the positive side, 17% to the negative. So it tended to beat the estimates. Okay, on the financials, and then we look at the price effect, because there are kind of like two estimates there. You have these analyst estimates, right? So we have analysts who follow, and they have whatever earnings per share, 20 cents, 30 cents, then you take the average. But those are analysts. The traders and the holders of the stock and the people who are repricing the stock every day may have much different expectations. They might be looking at different things and pricing it in a different way than analysts do. They might look at what the analysts think, but they have their own opinion, right? They have their own opinion about what how to price the stock, its projected earnings per share, its projected revenue, or maybe even something else that they feel is more important than the earnings per share. Sometimes you get stocks where the earnings per share is not even that relevant because they're looking at, they could be looking at maybe subscription growth, or, in Amazon's case, they grow with a low earnings per share because they're taking their earnings and reinvesting it into high growth, right? So investors could be looking at something completely different, than even these numbers. So that's why we look at the impact to the stock. Well, how did the actual stock traders reprice the stock? What did they feel about the earnings? So you could have a miss, you could have really bad number, but you could still have a positive reaction to the stock because the management said something, or we had negative number due to this, maybe we have to settle here, it's a one-time charge, or we took on this expense, but our subscriptions grew, or we have this thing coming up. So there doesn't have to be a necessary correlation between an earnings beat and the stock movement. Okay, so those could move in even in opposite directions, but we do just show you the at least this history of what's going on. So now we get this, 1 day reaction. We get the earnings per share, we get the revenue, then we get the full financials, the management's comments, conference calls, and the price impact, and then we kind of enter into this period until the next quarter where we're going to get the more new information. And so what does the stock tend to do in between that period, right? It's not like we only have 4 days of trading, we have continuous trading in between. So that's what we're referring here as the drift, okay, between earnings. And here you could see on average, if we took just the average of all the drifts, so if we excluded that 1 day big impact, right? But let's say you only held the stock, you bought it after it reported earnings, the day after, it sold it the day before, or right before it reported earnings, and then bought it back again after. Okay, so you're excluding that. On average, the stock gained 9.4% in the last 12 quarters. Okay, so it has a positive drift. 67% of those observations, the stock was up, 33% it was down. Okay, the drift from that initial mark to the high, to the high in that quarter was 21.4%, and to the low 11.1%. So we get this kind of like volatility range, or potential range. You could see it's wide, but looking at it, there's also a skew, it appears, towards the upside, right? So if we look at these three numbers, on average, it's positive with more frequent moves to the upside than downside. And as far as the extreme moves, it looks like it's skewed towards the upside than the downside. Okay, so that's really quickly just getting a sense of how this stock tended to perform, day of earnings and post earnings. If we look at absolutes, right, which says, okay, just give me take all the numbers and put them into positives because I want to see magnitude of moves. So downside move or upside move, I just want to know the magnitude of the move. We look at absolute numbers, and here we see that on average, the stock up or down moved 11.3% last 12 quarters after earnings. So this is a one-day move with a standard deviation of 8.3. And the largest move was 24.6, lowest move 2.7%. It's a very wide range. You could see that even after reporting earnings, we could have it had a really big up 20, a 24.6% move. Right? Because look, down here somewhere, this one, I think I don't see it like here, 24.6. So it's down 24.6 in one day. Right. So that's a really big move. And this is a one-day move after reporting earnings, but you could see it even followed up by 23.3% move to the upside. So it could have very violent move after reporting earnings or very muted move too, 2.7%. So this is telling us that the range of potential moves here is very wide. When you're looking at trying to give a potential movement after earnings, it's very hard because you got a very wide range from very kind of muted move of 2.7% to a very high move of 24.6%. So there's a lot of uncertainty there, a lot of potential for large or small move. That's definitely important, especially if you're looking at straddles. And so when you're doing that, you have to keep that in mind. Earnings surprises here, in absolute, these are kind of same thing. The range of 47 cents. So with a standard deviation of 36 cents. So you could see that the estimates, right, the average estimate versus the actual, there's a good amount of discrepancy, right, error there. It's a 47-cent error on average. So it's not like the analysts are getting it very exactly on the number. You could see that even the analysts themselves, there's a 47-cent on average error with a standard deviation of 36, with error by as much as $1.26 as low as 7 cents. Same thing here with the revenue. Okay, so that's just measuring the error of the average estimates versus the actual. As far as the drift goes, if we looked at, so this is the average drift that averages the negative and the positive to get us the skew, right? So the skew is towards the upside. But if we just looked at the average drift, and it doesn't matter if it's up or down, right? If we just wanted to see the magnitude of the drift between earnings, that's 20.5%. Okay, that's saying if we looked at the drift, these are the drifts. Okay, and we converted the negatives to positive numbers just to see the magnitude, like where, potentially we could end up, up 20 or down 20 or, on average. So that's what we're doing, is looking at just the magnitude, converting them all to large numbers. You could see you got like a 20% average move, 20.5% average move after reporting earnings to the next earnings, right? Up to the next earnings. So there's a lot of volatility here in the stock. You got 20% potential move in a quarter, without an earnings release. Standard deviation here, and this is the max and min. So this is also important. You see that the range, as much as 56% move, in the quarter, and as low as 3.9%. So that's also important when you're looking at options and you're trying to figure out volatilities, and you're saying, okay, what are the options right now? 3-month option, what is it pricing? 20% move, 30% move, 50% move, 10% move, and where does that fall in the historical range? Are we on the low end, high end, middle? So now you get this range of history in the last 12 quarters, 56% move. You could take a look here, over here, on February 1st, all right? That earnings, you could see the stock moved, from 97 as of the closing price to 188, 56% gain. I'm sorry, this I think includes the earnings. So it actually gained 23% on the day of earnings. But not including that, was a 56% gain. Okay. So the drift to the high and to the low, this measures where from the close, okay, the stock's moving around, right? So it's moving around until the next close before earnings. Well, we could look at the drift, but in between it could also, get higher or lower. So on average, how far away can it drift up or down in between those earnings, right? So this is the drift to the high in that period and to the low. That's what this is, okay, to the high and low. So the average move to the high is 21%. The average move to the low, 11.4. So this also shows us a skew towards the upside. And the biggest move to the high was 56.8%. The biggest move to the low was 28.9%. Again, very wide range, but it also shows there was a skew in meta that tended to be towards the upside. Okay. Now, median, min, and max, that's trying to say, okay, there's averages, but what about the median, just to get those, to see where the skew is. We look at the data points, we sort them from high to low and see like right in the middle. Okay, so if we sorted all the price impacts from high to low for that 1 day after earnings, half of them were above 4.4%, half below positive 4.4%. The median surprise was 28 cents. Median surprise of the revenue was 602 million. The median drift was 9.3%. So half the observations were above 9.3%, half below. The median move to the high is 19%. Median move to the low was 9.7%. Okay, so this really quickly gives us a visual of how the stock reacted on earnings and how the stock behaved in between earnings. And the takeaway here is that in Meta's situation, if we look at the last 12 quarters, in between earnings, keep in mind, this doesn't include the earnings, but in between earnings tends to have a positive drift on average of the last 12 quarters of 9.4%. So negative and positive drifts. It tends to, the extreme moves tend to have been skewed to the upside. Okay, so it had shocks for sure. It did have shocks to the downside and to the upside, but you could see that the volatility to the upside could be just as violent, if not more, than the downside. So if we're looking at skew, if you're looking at wings, calls and puts, and you could see the, well, what does the skew look like? Even if the puts look skewed towards the higher than the calls, the history doesn't support that, that downside risk is necessarily more violent than upside risk. Okay. I mean, we could take a look at the skew right now. Just really quickly, let me take a look at the skew. So maybe a visual. Okay, so this is kind of the skew 30-day. And it does kind of show that the wings to the upside, right, are, this might change because this is looking at it, as of close of yesterday's when it reported earnings. So we'll take a look at it afterwards, but it does show that the wings to the upside are skewed a little bit higher, just like to the downside. So it's not like a sloping down skew, a vertical skew. So we're right up at 9:30. I think I'm gonna stop right there.
Yeah, that was great, D. Could you just do Michael McCrae was asking if Market Chameleon was thinking of using any of the large language models within our information data. And I did mention I referred to it as Ask AI. I didn't realize that it was changed to Help AI. If you could just point that out, it's in the upper right-hand corner. It's one place we're using it amongst others right now. But
yeah, so there are certain processes, yes, that we are using it, and certain processes we're developing. The LLMs, but one, that you could interact with right now is this Help AI. You click on it, try to ask it questions, and this is still being built. You have to be either registered or subscribed. So even if you have a free registration, you could use it. We don't want, bots abusing it. But if you type in questions, it tries to answer them based on, we scanned our website, we gave it, instructions and, its understanding. So this is the first. We didn't have this actually out for a while. I think it's been less than, a month, couple of weeks.
Right?
Yeah. So the idea there is that, we will continue to work on getting it better and better. And I think it's in itself, it is kind of designed to get better as it's, learning itself, from the interactions. But this is our first help assistant, using the LLMs. And we do have processes in the background that we're using in the LLMs that you're getting the benefit of it on the website, but you're not directly interacting with it.
Yeah, that's great, D. And thanks for all the questions, everyone. Thanks for the great webinar, D, as always. Everyone have a great trading day, and we will see you tomorrow. Have a great day. Thanks, D.
Thanks, everyone.